Hi learners, welcome back to CA Foundation Principles and Practice of Accounting Marathon Revision. We are in part 5 or lecture 5 of our CA Foundation revision. In the past we have revised till chapter 6 and in this video we'll start with chapter 7, Final Accounts of Sole Proprietors. So let's get started, and before I go any further ahead, a small announcement that I've been making to all of you people in the past 3-4 videos as well. You guys have an amazing free mega revision test series coming up from 15th of June. 15th of June at 2 p.m. will be accounts, and followed by 18th, 21st and 23rd for law, maths and economics. It's going to be 30 minutes, 20 MCQs, which you guys can attempt for free and then test your examination preparations. What are you waiting for? Download Unacademy application today. Take up this free test revision series to test your exam preparation. Also coming up on June 12th is CA Intermediate Mega Combat. This will give you huge discount on your CA Intermediate subscription, which is definitely the need of the hour post your CA Foundation examination. Again, this can be taken up for 60 minutes and it will be of 40 MCQs, and it's at 12 p.m. on June 12th. Enroll today and use the code YESHAS, which is YESHAS, to unlock this mega combat. You know the iconic program, which is a flagship model of CA course under Unacademy. So this gives great benefits of one-to-one mentoring, one-to-one live doubt solving, and evaluated test series will be conducted wherein the feedback will also be given as to how do you improve your exam preparations. You get the printed copy of the material at your doorstep, and you get to be part of not discussion channel for all your doubts, and you also get to attend sessions taken by industrial experts. So what are you waiting for? Take up Unacademy iconic subscription, which is over and above the normal plus subscription of live classes, recorded backup being available, one subscription giving access to all the educators notes and regular doubt solving sessions. So that's the point. And talking about the subscription cost for 24 months is 41,000, for 12 months it's 28,600, on 6 months subscription cost 20,500, and you can use the code YESHAS live to get 10% off on the prices that you see here on the screen. And that's it guys, hoping to see you all on the Unacademy platform very soon, wherein we take up our classes in the full stream mainstream way comprehensively in English for CA Foundation, CA Intermediate and beyond. Fantastic. So without wasting much time, come let's get started with our topic of financial statements or final accounts of sole proprietors. So from this chapter you will get questions on manufacturing concern as well as non-manufacturing concern. So talking about final accounts, entire final accounts can be classified into two major classifications. One, to evaluate financial performance, other one to evaluate financial position. To evaluate performance, we prepare manufacturing, trading, Pnl appropriation. To evaluate financial position, we can prepare balance sheet and cash flow statement. Now, manufacturing account. Now, talking about manufacturing account, trading account. Is it manufacturing account or trading account, or is it manufacturing account and trading account? That's a question to which lot of students answer wrong in spite of attending regular classes to the extent possible. You get this? So let us answer this question this way. So with regard to an entity, you need to check if the entity, is it trading, is it buying and selling the goods, or is it manufacturing and selling the goods. So a manufacturing entity will buy raw material, convert it to finished goods and sell finished goods. A trading entity will buy finished goods and then sell finished goods. One common point here is selling. Both the entities will sell finished goods. Both entities will buy, but manufacturing entity will buy raw material, trading entity will buy finished goods all by itself. So if an entity is a manufacturing entity, it will prepare manufacturing account and a trading account. If it is only trading entity and a non-manufacturing entity, it will still prepare trading account. So trading account is not an option. Trading account is must. If you are a manufacturing entity, you additionally prepare manufacturing account also. That's the point. Now, with regard to inventory, we have three variants: raw material, work in progress and finished goods. Raw material will appear in manufacturing account. Work in progress will also appear in manufacturing account. Finished goods will be transferred from manufacturing account to trading account. So in the manufacturing account, we'll write opening WIP, closing WIP, debit, credit. Raw material will be not be written opening, purchase, opening and then closing on debit and credit side. We identify the consumption of raw material in conversion of work in progress to finished goods. That is identified by taking opening raw material, add purchase of raw material, less closing raw material. That will give us consumption. To this we add up our manufacturing expenses to arrive at what exactly is the cost of production of finished goods, which will be transferred from manufacturing account to trading. And in the trading accounts, my friend, on the debit side, After opening stock, we usually write purchases. If it is a manufacturing entity, in place of two purchases, we'll be writing two manufacturing account. So let me help you all understand the format of manufacturing account. Manufacturing account is prepared at the factory. So if in case you open the doors of the factory, what you find at the factory is opening work in progress, closing work in progress. And during the year, certain raw material is opening value is there, purchase and closing will write. That will give us the consumption of raw material during the year. To this, if we add the expenses incurred for converting raw material to finished goods, we will understand what is the value of finished goods transferred to trading account. This is found as balance sheet figure. There is not going to be any profit on manufacturing process. Manufacturing account is prepared with the objective of identifying the value of goods transferred from manufacturing to trading. That is the cost of production. That is the objective of manufacturing account. There is no profit in manufacturing. Profit is at the time of sale. So if there is any sale of scrap, it's simultaneously written in manufacturing account. Then we'll go down to trading account. In the trading account, we'll write opening finished goods on the debit side, closing finished goods on the credit. If there is finished goods purchased, because it is not a manufacturing entity and a trading entity, we'll write two purchases less returns. If it is a manufacturing entity, they would not purchase finished goods. Finished goods will come from manufacturing account. To this, you will write any other wages incurred in the process of trading and will write the sales amount less of returns. Once you do this, you will arrive at gross profit as balancing figure in our trading account. Got it? Once the trading account is done, this GP is transferred to Pnl account. So we will write it in our Pnl account. I'll just show it to you. Give me a moment. So we'll go down to Pnl account next, and Pnl account we will write GP. We'll write our indirect incomes if any, write our gross loss if it's on the debit, and indirect expense to find net profit. And this is the balancing figure which will go to Pnl appropriation, from there to balance sheet. However, at CA foundation level, you don't have any questions on appropriation. So balance will be straight away added to the capital in balance sheet. Got it, guys? Fantastic. Now let's quickly understand quite a lot of other topics in the preparation of trading account. Now information for trading account will come from trial balance. So trial balance will have opening stock, trial balance will have purchases, sales, as well as direct expense. So on the debit side, you'll have opening stock, purchases. On the credit side, you'll have sales, and direct expense will again be on the debit side. Closing stock will always be available in adjustment. You guys get this? We learned no chapter 4. In the second video, I taught it to you. I told you closing stock is not a transaction, but it's an event resulting from transactions. We compute closing stock outside the books of accounts. We compute it, we bring it into books of accounts. This needs to be entered into double entry system, meaning we'll write it in the trading account credit side as well as in the balance sheet asset side. You would have to do both. So that is the reason it will be available in adjustment. See, it will be written in trading account credit side as well as balance sheet asset side. However, if closing stock is why is closing stock appearing in adjustments? I just answered that to you. Can we include closing stock in trial balance? Yes. If closing stock appears in trial balance, it should appear both debit and credit because it's an off balance sheet item. If it comes on both sides, debit and credit, debit aspect will go to balance sheet asset side, credit aspect will go to trading account credit side. However, the credit aspect of closing stock in the trial balance can be put along with opening stock and purchases to arrive at adjusted purchases or cost of goods sold. We all know this, right? Opening stock plus purchase minus closing stock is cost of goods sold. Opening stock debit balance, purchase debit balance, and the credit side of the trial balance may closing stock part can be adjusted together to arrive at cost of goods sold or adjusted purchases. If cost of goods sold or adjusted purchases is there in the trial balance instead of opening stock and purchases, in such a case, closing stock will not be appearing in the credit side in trial balance. It will be appearing only on the debit. Why? The credit aspect of closing stock is already adjusted with purchases and opening stock to arrive at COGS. What do we do in that case? The debit balance of trial balance may whatever is there, no closing stock, that will be straight away taken to balance sheet. So that's the important point that I was trying to convey here. On this, the questions do come in the exam. I hope you'll remember this. Next thing is discount. With regard to discount, in the questions there can be two sorts of discount: trade discount, cash discount. Trade discount is a discount given at the time of bargaining, purchase, sale. This will be adjusted against the price and will arrive at the net figure. However, cash discount is a discount that is given at the time of settlement in cash, not at the time of trade. You bought the goods today or you sold the goods today. This needs to be settled in cash at a later date. No, on that later date when it is settled in cash, that's when we give discount or receive discount. That, my friends, is cash discount. For cash discount, we are always going to write accounting entry. There's going to be accounting entry for this. There's going to be accounting entry for this cash discount. However, there's going to be no accounting entry for trade discount. It will be adjusted. It will be adjusted against the price. I hope you guys got this part. Did you? Yeah. Okay. Then the next part, stock. Lot of times stocks can be issued otherwise than by way of sale. What are the times where the stock can be issued otherwise by way of sale? One, for private use. Whenever the proprietor withdraws the stock for private use, it is to be considered as drawings, and the journal entry for the same will be drawings account debit to purchase account. It will be deducted from the capital and deducted from purchases. Yeah. And whenever the goods are given away as charity, such charity or donation is not business expense. It is again personal expense, and it has to be again debited to drawings and credited to purchase account. So whether goods are used for private purpose or given away as charity, entry will be drawings to purchase only. If the goods are given as advertisement or free sample, advertisement expenditure will be debited and credit will be given to purchasers. When the goods are destroyed by fire, we would have to write Pnl account debit to purchasers if it is not insured. If it is insured, you will write insurance company account debit to purchase, because insurance company will reimburse that expense to you. If it is partly insured and partly not, to the extent insured, you write insurance company debit. To the extent not insured, it will come in Pnl account debit as loss. Ultimately, it will decrease our purchases. What I want you all to remember very importantly is, whenever goods are issued other than by way of sale, we cannot write sales account credit. We'd have to decrease it from purchases, because all of these transactions, whatever I mentioned right now to you, these have to be adjusted at cost price, because there is not going to be any profit. Yeah, there's not going to be any profit. All adjusted at what price? Cost price. Adjusted at cost price. It's not written at selling price. So we will write these entries as deduction from purchases and not addition to sales. You got this? Because see, I withdraw goods. Will I make profit from the same? No, I will withdraw them at cost. Got it? And even when the goods are given to employees, you would again write salary account debit or employee advance account debit to purchase. It has to be deducted from purchases. It cannot be written as an addition to sales. I hope you all got this and will remember this in the problem. We cannot do final accounts big lengthy problem in marathon revision, but I'll revise all the concepts which is very much required in solving the big problems on the topic of final accounts. Got it, guys? I hope you did get. Chalo, let's get going. Next one, distinction between direct and indirect expenditure. So if the expense is directly related to manufacturing, it will come in manufacturing account. If the expense is relating to trading of goods, it will come in trading. If not, if it is indirect, it will come in P&L account. For example, wages paid for manufacturing wages, manufacturing account. Wages at the warehouse, trading account. Salaries paid to employees, P&L account. Lighting and heating expenditure, manufacturing account. Warehouse lighting expenditure, electricity expenditure, trading account. Office lighting expenditure, P&L account. Rent of the factory, manufacturing. Rent of the warehouse, trading. Rent of the office, P&L account. So depending upon the place where such expenditure is incurred, we can segregate them into manufacturing, trading and PL. Yeah, if you write a manufacturing expense in trading account, the answer would go little wrong. So remember that and then stay little cautious with that. And P&L account, I've already explained it to you. Certain expenses and income items, will understand this part, the deferred revenue part along with accrual part. Expense or income need to appear in P&L account. I told this to you here. In P&L account credit side we write indirect income, and P&L account debit side we write indirect expense. This expense needs to be written on accrual basis. Entire current year expense should come in P&L debit. Entire current year income should come in P&L credit, irrespective of the fact whether it is paid or not, irrespective of the fact whether it is received or not. Yeah, if expense is 10,000, paid is 10,000, fantastic, no problem. If you pay more than the current year expense, that is called prepaid expense. What is it? If the expense paid is more than the current year expense, or we can say money paid but benefit is not taken, that is prepaid expense. However, this will not be part of our current year expense. It is next year's expense paid now. So in the current year, it will not come in P&L account. It will be recorded in balance sheet as an asset. entry will not be expense to cash. Instead, the entry will be prepaid expense to cash. If it is expense to cash, it will go to P&L debit. If it is prepaid expense to cash, such prepaid expense will go to balance sheet as asset. Done. Next part, we need to write outstanding expenses as a liability. What is outstanding expense? Expense is incurred, amount is not paid. So benefit is taken, money is not paid. When the benefit is taken but the money is not paid, benefit is taken, it is current year expense, it will come in P&L account debit. It is outstanding, no? So outstanding expense will be credited. Outstanding expense is liability. It will come in balance sheet as liability. If it was paid, it would have reduced our cash. Because you have not paid, it will come in balance sheet as liability. I hope you guys got this. Let's go to the next part. We have incomes coming up next. Yeah, incomes. Pre-received income, meaning if income is earned, income is received, no problem. What is received is what is earned, no problem. It will come in P&L account and cash account debit. If you have received some money and you have not earned it, you have received some money but you have not earned it. Next year's income received this year. That's what we call as pre-received income. What is it? Money received but we have not given the benefit yet. We have not earned it yet. Such amount is liability. Cash will be debited and pre-received income will be credited and it's written as liability in the balance sheet. Next up we have accrued income, meaning income is earned but not received. Benefit is given, income is earned but money is not received. So in this case, because you have earned the income, you will credit your income. It will come in P&L account credit side. It cannot be written in cash account debit. Instead, you will write in balance sheet as accrued income. Got it, guys? So this with regard to expense and income. Same concept will be revisited by us in the chapter of NPO. Please do remember. Yeah, fantastic. So remember, current year expense, current year income will be written in P&L account, whether paid or not, whether received or not. If it is received in extra income, it will be liability. If it is not received income which is earned, it is asset. With regard to expense, if it is paid more than what we have incurred, it will become asset. If you have not paid, though we have taken the benefit, it will become liability. So you need to remember what is outstanding expense, prepaid expense, what is accrued income and pre-received income. Once you get this, lot of other items with regard to your chapter of final accounts will get sorted. Yeah, then that's what I was telling. This topic is to be read in NPO chapter also. Yeah, got that. So then we have remuneration. These questions usually come in the chapter of partnership also. Usually they ask more there and less here. However, we'll cover it in both places. Managerial remuneration. Yeah, it can be given as a fixed amount. They can say 1 lakh rupees per annum, 10,000 rupees per month, 50,000 per annum. They can tell that. Or they can keep it as a variable amount on profit. Manager can be given commission as a percentage of profit, which will result in higher remuneration in the case of higher profits, lower remuneration in the case of lower profits. Is that possible? Absolutely yes, that is possible. Yeah, in such a case, what do? We can compute it either on before charging basis or on after charging basis. So how do we get to know whether it is before charging or after charging? This will be mentioned to us in the question. The question will tell whether to compute managerial remuneration on before charging basis or to compute remuneration on after charging basis. If they say before, if it is X%, you do X by 100, simple. If they say after, you do X by 100 plus X. You should do X divided by 100 plus X. So this is the tricky part and this is what you need to remember. You guys get this? So if they say 10% of profit as remuneration before charging basis or before charging such commission, you will do profit into 10 by 100. If they say profit remuneration is to be given at 10% after charging such commission, then you will do profit multiplied by 10 divided by 110. Meaning after paying such remuneration or commission to manager, whatever remains, that profit may 10% should be the remuneration what was given. So before remuneration given, whatever was there was like 110. Out of the 10 is given and 100 is remaining, isn't it? So that's the logic. Yeah, I can teach this in a little lengthier format, spending some 30 minutes. In fact, I've done a YouTube session on this very thing. You just search for trick problems on managerial remuneration on YouTube. You will find with my name CA Rajavardhan. You will find lectures on this. We have done good 1-2 hours of revision exclusively on this problem, so you can understand that. If you want detailed understanding, you can do that. If not, remember before X by 100, after X by 100 plus X. That's it. That's how we compute managerial remuneration. Done. So then adjustments can come with regard to sundry debtors. With regard to sundry debtors, remember sundry debtors is an asset. It will appear in the trial balance on the debit side. You would have to take it to the balance sheet asset side. Khatam. Bad debts is an expense and it will reduce debtors. Journal entry for bad debts is bad debts account debit to debtors account. Bad debts is an expense, debit. It will reduce our debtors, credit debtors. The entry is bad debts account debit to debtors account. Then this bad debts needs to be posted to P&L account. So we will write the entry P&L account debit to bad debts. That is transfer of bad debts to P&L. And provision. Provision is a liability. When you create it, it is an expense. So entry for provision is P&L account debit to provision account. P&L account debit to provision account. This is the entry. So remember, debtors is an asset, trial balance debit side, so you will get it, you will put it to balance sheet asset side. Bad debts is an expense and it will reduce debtors. Entry for bad debts is bad debts to debtors. Bad debts account debit because it's expense, debtors account credit because it is decrease in the asset. And provision is a liability, but when you create it, it is an expense. So journal entry for provision is P&L account debit to provision. P&L account debit because it is expense, provision credit because it acts like a liability. These are the entries. Now let's go into our concept of additional bad debts, additional provision and all of this. Yeah, try and understand. Bad debts ke liye you need to pass two entries, bad debts to debtors, P&L to bad debts. If in case bad debts is given in trial balance, then it means that this entry bad debts to debtors is already passed. It's already passed. We don't have to pass this entry. You will only deduct it from debtors in it's already deducted from debtors. We will only post it to balance P&L account debit side. Only the posting entry is to be done. If bad debts is appearing in adjustments, then this entry of bad debts to debtors also should be passed. P&L to bad debts entry also should be passed. Meaning we need to deduct bad debts from debtors as well as write it in P&L account debit side. You got this? Let me repeat the bad debts adjustment. If bad debts appears in trial balance, it means that bad debts to debtors entry is already passed. We don't have to pass that entry anymore. We don't have to deduct bad debts from debtors anymore. Only thing that we need to do is we need to write this bad debts in P&L account debit side as expense because the second entry is not done. However, if bad debts appear in adjustment, it means that bad debts to debtors entry is also not passed. Transfer to PL entry is also not made. So what should we do? We should write the entry bad debts to debtors and reduce it from debtors in balance sheet. Also post bad debts to P&L account debit side as an expense. You need to do both. I hope you guys understood this part. Next, let's go to provision. Provision. There would be some provision already there in the trial balance. What do? We don't have to write this entry. This entry is already passed. That is the reason provision is appearing in trial balance credit side. What do we do with provision? It's a liability. Should be written in balance sheet liability side. However, as a matter of presentation, they belong to the same family of debtors. So instead of writing in balance sheet liability side, we'll deduct it from the debtors and write it in the balance sheet asset side. Let me repeat, provision is a liability. It needs to be written in the balance sheet liability side. However, as a matter of presentation, instead of writing in the balance sheet liability side, we'll deduct it from the debtors in the balance sheet inner column. Is there an entry for such deduction? Provision to debtors or something? No. It's only presentation part. Sir, this is okay, sir. What about additional provision or they give in adjustment? That's the interesting part. Whenever they give provision in the adjustments, then what to do? Pretty simple. Adjustment mein whatever comes is the total provision, correct provision amount. So check what is the existing provision. Assume that trial balance mein provision is 1000. Adjustment mein provision is 1500. So provision is already there for 1000 rupees. Adjustment says provision needs to be maintained at 1500. So 1000 is there, 1500 should be there. So what does it mean? Provision needs to be increased by 500. So what should you do? For 500 rupees, you need to write the entry P&L to provision. 500 rupees additional provision created, P&L account expense. To the existing 1000 provision, we add 500 new provision created. Total provision becomes 1500. But in your class 12 or second PC, you don't do that. You write off entire old provision, create entire new provision. Hey, provision is provision at the end of the day. 1000 provision is already there. 1500 is the provision to be maintained. Create only 500 provision. No, over. Why do you have to write off that 1000 provision and newly create 1500 provision? You don't literally do that, but you do that minus 1000 plus 1500. You do all that in P&L. Don't have to do only 500 rupees additional provision. Alternatively, if in case provision is 1000 and the question says provision is to be maintained at 900, 100 rupees provision is to be written off because already you have 1000 no trial balance, but adjustment says provision is to be maintained at 900. 100 needs to be written off. So what do we do for 100? Ulta. Instead of writing P&L debit to provision, we'll write provision debit to PL. And this will appear in Pnl account credit side as income because provision is no longer required and it is written off. Understood? I hope you guys did understand with regard to Sunday debtors, bad debts and provision. Yeah, I'll soon come out with another detailed video on how to deal with debtors, provision and Sunday debtors, like the entire family car adjustment. That will be a detailed 2-3 hour video with lot of small questions. In fact, it is there in the Excel sheet that I was using as well. It is there in here. You guys can access it. I can share it with you people. If you guys text it to me, I can share the link to this Excel sheet. Here we've done a lot of kuti questions to understand this in detail. Let me show. Point is, the entire final accounts, entire revision is going to be let's say a short one. If I do some 35-40 hours revision, it will not be called marathon. You guys would not watch it also. You will be like, what 30 hours revision? Revision has to be quick. Revision has to be crisp. That is the reason I am skipping that. If not, I would show it to you in detail, guys. See, this is that commission managerial remuneration computation detailed with explanation. Yeah, example number 1, example number 2. Why is it like this? Try this, another alternate logic. Everything we've done. Yeah. Bad debts I'm not able to find. If in case I find it, I can show it to you. We've done a lot of small questions to understand how to deal with bad debts, and then we did one big problem to understand the same. See here, Sunday debtors and family. We have it in detail. Sunday debtors is an asset, bad debts is an expense, provision is a liability. Small problems. Yeah, we did small kuti. See example 1, kuti problem. Yeah, trial balance. Debtors is 1 lakh, bad debts is 10,000. How do you adjust? Then there is additional bad debts of 2,000. How do we adjust? Total bad debts is 12,000. How do we adjust? Then we'll bring in provision to be maintained at 10,000, provision to be maintained at 10%, provision to be maintained at 7,000, which needs rating off of some amount of provision. There is additional bad debts and provision. There is additional bad debts and provision at percentage. So all of this, for each of the case, we've done P&L extract and balance sheet extract. I can share this sheet with you. It is self-explanatory. You see this, and gradually, case by case, the difficulty level goes on increasing. Yeah, if in case I start explaining this in detail, my entire marathon revision, which I planned for 5, which is now going down to become somewhere around 6-7 hours, will end up becoming 10 hours. So that will become too much, and that will create disinterest in you to watch. So if you guys want it, please do ping me. I will share this Excel sheet with you. You can see those small capsule problems to understand the bad debts and provision topic a little better. You guys got this? So chalo, let's get going to the next part. Here I am. So Sunday debtors part done. Then we'll go to balance sheet. So balance sheet mein we'll write fixed assets and current assets on the asset side, capital, non-current liabilities and current liabilities at the bottom. So the capital will take the opening capital of the previous year. To this we add the current year profit, deduct the drawings, also adjust for interest on capital and interest on drawings, and that's how we finally arrive at capital. So I've tried to cover the entire final accounts of sole proprietorship with regard to adjustments in detail here. I hope this was helpful. And one small theory question that you need to remember is what is the order of writing the entries in the balance sheet. So it's called as a reversed liquidity order, or it's called as a reverse liquidity order. That's the order of items in the balance sheet. It's like order of permanence. Permanent items on the top and then non-permanent items at the bottom. Non-current fixed items at the top, current items at the bottom. So this is called marshalling. Marshalling is the order of items in the balance sheet. Remember the name? What is it? Reversed liquidity order or order of permanence. That's what we follow. Reverse liquidity order, or also called as permanence. This is the name. there can be a I would say an MCQ question usually that used to come in CPT level on this point. But now the CPT questions are no MCQ questions are not there. It's all about 2 marker, 4 marker, 6 markers and all. But still good to remember, good to know. Yeah, know this fact, and that's it, my friends. We are done with the chapter 7, that is final accounts. Let's now get into chapter 8, which deals with partnership accounting. Shall we start with partnership chapter 8? So maybe in this, if I can finish partnership, in the next one I can take up company accounts and NPO. Let's see if we can fit into this 5th one, or we can do a 6th separate video. Chalo, let's start with partnership accountings, that is chapter 8 of your CA foundation syllabus. What do you mean by partnership? Partnership, the definition is there. I'll see if I've covered it up in the Excel sheet up here. Yes, we have. It is an association of 2 or more partners coming together for the purpose of business to share the profits and losses arising thereon, where activities are carried on by all or any one of them acting from. You got it? So this is the definition of partnership. And then number of partners in partnership is, according to section 464 of Companies Act 2013, maximum number of partners is 100. However, as per company rules, maximum number of partners is 50. So what do we follow? We need to follow both. So a company cannot have more than 50 people. Sorry, a partnership cannot have more than 50 people. If it has more than 50 people, it becomes illegal association unless it gets itself registered as a company. So Companies Act will tell how many people can be there in partnership. How does it say? It says any number, any organization, not just partnership, any form of organization which has more than 50 or more than 100. Either rule says 50, act says 100. If it has more than such number of people, and if it doesn't register itself as company, then it will be illegal association. You get that? So a partnership firm will become illegal if it has more than 50 people. So maximum limit is 50 in that case. You get this? And there is a provision that allows partner in the case of profits only. Yeah, there can be people who take care only profits and they'll not take losses. If there is profit, I'll share. Loss, I'll not share. Can be. And there is a possibility to have an inactive or dormant partner also to the firm. Are the terms partner, partnership and partnership firm same? No, they're different. Partner is the individual. Partnership is the relationship between these two individuals. Partnership firm is the name under which these partners perform their business. Got it? There is no mutuality. Partners represent the firm. So if partnership is liable, partners are liable. You cannot say partnership and partners are two distinct persons. No. There is no separate legal entity. Partners itself represent the partnership firm. Separate legal entity is there only in the case of company. Yeah, it's a body corporate. Got it? Then partnership firm is constituted based on an agreement called as deed. Agreement of partnership is nothing but deed. It is called as partnership deed. Partnership deed can be oral or can be written, or it can not be there also. However, if the partnership deed is not there, then the partnership firm cannot get registered. If the partnership firm doesn't get registered, then what happens? Yeah, outsiders can sue the firm, but the partnership firm cannot sue outsiders other than for an amount lesser than 100. If it is more than 100, they can't sue. Sir, 100, really? Partnership Act is made in 1932. Back in those days, 100 was a good amount. So they had kept like, okay, if you are a small business, you don't have to register, you can still file cases for 100 rupees. But if you are filing case for more than 100, it means that you are a big firm, you should get registered. That was the logic. Now, though it doesn't make logic at all. Yeah, if your partnership firm is not registered, outsiders can sue you, but you can't sue outsiders. Yeah, remember that. Let's go to the next part. So what are the contents of partnership deed? If in case you make partnership deed, it can be oral or written. If it is written partnership deed, it will have the name of the partnership firm, address of the partnership firm, name of the partners, address of the partners, capital contributed by them, profit sharing ratio, what is the interest on capital that can be given to them, what is the interest on drawings, what is the salary that should be given to any of the partners if they are eligible, what is the role and responsibility of each of the partners, and what do you say, then how to deal in the case of death of a partner, when will the partnership firm till when will it exist, in the case of dissolution how to do, who gets what, all these terms should be, goodwill how to compute. Yeah, everything will be discussed in the partnership deed. If the partnership deed is oral or if the partnership deed is not there, then the savior is section 13 of Partnership Act 1932. You need to follow section 13 of Partnership Act 1932 whenever there is no Partnership deed. What does section 13 say? Section 13 has 5 clauses, A, B, C, D, E. These 5 clauses will tell how to deal in the case of absence of partnership deed or oral partnership deed, or partnership deed is there but it doesn't talk anything about these points. Then you would have to follow this. Number 1, it says profits and losses are to be shared equal. Whenever there is no partnership deed or partnership deed is silent, profits and losses should be shared equally between all the partners. And the second point is there is no salary, no commission, no remuneration to any of the partners. And all the partners will have equal rights, equal responsibilities. It cannot say I am responsible for this, you are not responsible for this, I have the right on this. No, all the partners have equal rights, equal responsibilities, equal role in the business, equal share in the profits, and no partner will get any salary or remuneration, whether they are active, whether they are passive, whether they are whatever it is. Done. No interest on capital, no interest on drawings. If partner has contributed any advance to the firm over and above his capital, then he can claim interest at 6%, simple interest. That's it. He can't claim 7, he can't claim 5. Do you get this? So this is the model deed which is given under section 13 of Partnership Act 1932. I hope you all understood this. Next part is P&L account and P&L appropriation account. We just touched this upon in previous chapter, that is P&L account chapter, but this will come in detail in the partnership chapter. P&L account is prepared to identify the profit. P&L appropriation account is prepared to distribute the profit. So activities between the organization and outsiders, so employee salary, rent to landlord, depreciation, and all other transportation, carriage, all other expenses will come in P&L account. But if there is any transactions between the firm and the partners, like interest on capital, interest on drawings, salary or remuneration to partners, share of profit given to partners, all of this will come in P&L appropriation account, because this is appropriation of income, not charge against income. Got it? Interest on capital paid to partners is not expense. It will not decrease your profit. Because there is profit, you are paying interest on capital. Because partner is not an outsider. You get this? So appropriation of profits is computed and written in P&L appropriation account. This will have transactions between partner and the firm. So any payment to the partner or receipt from the partner will come in P&L appropriation account. Other than interest on loan given by partner to firm. That is like an outsider is given loan. So like an outsider, firm will pay interest. That will come in P&L account only. Other than interest on loan given by partner to firm, other than that, for rest all the transactions between partner and the firm, like interest on capital, interest on drawings, salary or remuneration, share of profit, everything will come in P&L appropriation account. So we do P&L, we identify the profit, we bring down that net profit. From that net profit, we pay remuneration to partners, we pay interest on capital to partners, we pay interest on advance. Oh, sorry, this is also I've given here. Yeah, this also, okay, fine. In certain cases, this also will be written here. And then what do? Then we write, actually this should not come here. Yeah. So we'll write the profit here. We'll write remuneration to partners and interest on capital here. And then the share of profit will be written on the, if there is any, will be distributed here. If it is loss, it's written here. You get this? So that's the point. And then capital accounts of the partners has to be learned how to prepare it next. So capital accounts can be prepared under two methods: fixed capital system, fluctuating capital system. Under fixed capital system, we prepare only one. Under fluctuating capital system, we prepare only one account, capital account. In that capital account only, we'll write capital, interest, drawings, interest on capital, interest on drawings, remuneration, share of profit, everything. So capital keeps on fluctuating. Capital is not constant, and this will make it actually difficult for us to compute interest on capital. However, if you want to keep the capital fixed and write all these transactions in a separate ledger, what do? We write the fixed capital as per the partnership deed in the capital account. We open one more current account. In this current account, we write interest on capital, interest on drawings, remuneration, share of profit. All this we'll write in here. That is fixed capital system, where the capital is fixed. So this is the format of fluctuating capital system, a partner's capital account. And this is the format of fixed capital system, a partner's capital account, and partners sorry, current account. Been taking class for so long, no, continuously, the throat has gone bad. Sorry guys, you had to hear all that. Done. By this we are done with our capital accounts. Remuneration to partners, as I mentioned to you previously, remuneration can be given either on before charging basis or after charging basis whenever it is given as a percentage of profit. If they give it on before charging basis, what do? We write it as profit multiplied by x by 100. However, if it is given on after charging basis, then we write sorry, profit multiplied by x divided by 100 plus x. We add x to the denominator, same what we discussed in chapter 7. Done. Kuti example problems are also there on that. Then interest on capital. Interest on capital is to be provided on the capital account balance only and not on the current account balance, and it is to be provided only if there is mention in the partnership deed. If there is no mention in the partnership deed, then there will be no interest on capital. Then interest on drawings, again it needs to be computed only if there is mention in the partnership deed, if not, no. If there is one drawing, you compute on that drawing from the date of drawing till the year end. However, if there are multiple drawings, you need to do multiple times interest computation. You can use this shortcut. If the same amount is withdrawn at the beginning of every month, then you can compute it for an average period of 6.5 months. If the same amount is withdrawn at the middle of every month, then you can compute interest for an average period of 6 months. If the same amount is withdrawn at the end of every month, then compute it for an average period of 5.5 months. Similarly, if it is at the beginning of every quarter, 7.5 months. If at the middle of every quarter, then 6 months. If it is at the end of every quarter, then at 4.5 months. If it is made at the beginning of every half year, then 9, in the middle of every half year 6, if it at the end of every half year 3 months. Or if the drawing is made but they have not told us the drawing, then you do it for an average period of 6 months. If in case the drawing is made on different dates and the amounts are different, then we can go by product method, which is similar to our concept of average due date what we did. Yeah, you can apply that and then compute the interest on drawings. I have solved an example problem on all of this. This and all you know how to do. You will take 1000 is withdrawn at the beginning of every month. So you do 1000 into 12 into 6.5 by 12 into 10%. That is rate of interest. Yeah. If it is made at the middle of every month, then you do 1000 into 12 total drawings into 6 by 12 into 10%. And then 6 months, 7.5, 6, 4.5, 3.5, all that. If it is product method, you do this way. You write the date of drawing. You write the amount of drawing. You identify the period in months from the date of drawing till the year end. For this period, this drawings is made. You multiply these two to arrive at product. You will take the total product divided by, if this is months, you will do 1 by 12. If this was days, you would have done 1 by 365. Multiply by 10%. This is just a shortcut. If not, you are supposed to do 3000 into 11 by 12 into 10%, 2500 into 7.5 by 12 into 10%. You are supposed to do individually. So the common part is this into this, no? On the total, you can do divide by 1 by 2 into 1 by 12 into 10%. That is common for all the drawings. So that is a shortcut that we do here. Understood? Then comes the share of profit. Whenever the profits are to be shared, the profit is computed after paying interest on capital, salary, commission, interest on advance if any, or any other payments to partner. Only making all of these, that's when we compute our share of profit, which needs to be shared between the partners. And there can be a special clause in the partnership deed which will guarantee a certain amount to any one of the partners. That is a guarantee given by few partners to one partner who's been joined because he brings in a lot of value to the firm. So people who are guaranteeing minimum money to the other partner are called guaranteeing partners. The partner who's taking the privilege of minimum guarantee is called as guaranteed partner. So if we guaranteed certain amount of money, what we do is first we divide the profit among all the partners in the profit sharing ratio. Then we check if the guaranteed partner has received the money that is guaranteed. If he has received minimum money, then good. If he is not, the balance money needs to be pooled in from the guaranteeing partners in the ratio that was pre-agreed to compensate to the guaranteed partner. You get this? So here I have solved a lot of examples wherein see Virat, AB and Nax are partners. Yeah, Virat, AB and Nax for equal share 1/3, 1/3, and Nax has been minimum guarantee of 1 lakh has been given. So if the profit is 3 lakh, all of them get 111. So there is no problem. His minimum guarantee is 1 lakh. However, if we go to a case where profits is 4 lakh 50, again no problem. Let's go to a case where profit is only case 3. Profit is only 1 lakh 80. The profit is 1 lakh 80. Everyone will get 60, 60, 60. Mr. Nax was promised 1 lakh, but he's got only 60,000. So what will he do? He'll ask for additional 40. that 40 will come from AB and Virat. Both of them have to contribute equally, 20-20. So their share will reduce from 60 to 40. AB also will reduce his share from 60 to 40. 20-20 they'll pool in to give to Nax to give him 40,000 and to retain him in the business. So this year they are sharing it in the equal ratio. Guarantee is given by Virat and AB in equal 1:1 ratio. But it can be in a ratio other than 1:1. Or it can be a case where only Virat is guaranteeing, AB is not guaranteeing, and Nax will remain guaranteed partner. All that is possible. At the merit of the problem, this adjustment has to be picked, identified, understood, and solved. So you guys can understand that part. And then the next part is distribution profits in the case of insufficiency. In a case where there is no sufficient profits and the profit is insufficient to either pay interest on capital also, then what do? Then the profits remaining will be first used to pay the interest on capital in the proportion of payable, and there is no share of profits. For example, there are two partners. Capitals are 1 lakh and 60,000. Profit sharing ratio is equal. In that case, if the profit available is not sufficient to even pay interest on capital, such profit will not be shared in profit sharing ratio. It will be shared in capital ratio. By this I mean to say that insufficient money will be used to pay proportionate amount of interest on capital. So it will be in capital ratio and it will not be in profit sharing. Got it? See here, if the profits are not sufficient to pay interest on capital in full, then such insufficient profits will be shared among partners in capital ratio and not in profit sharing ratio. See, logic. Interest on capital payable is greater than net profit available. So we don't share profits without paying interest on capital. So we pay proportionate interest on capital available from net profit. This is same as distributing profit in capital ratio. Got it? So we used to do a lot of small problems on this to make people understand the concept and a lot of other things. So I hope you all are now clear with the introduction of partnership part. So if you are clear with the introduction of partnership, let me now take you all to the goodwill part, and then we'll do admission, retirement, and death. Yeah, I hope it's all going good and fantastic. The recording is great. Chalo, let's now go to goodwill. So what is goodwill? First and foremost thing is, it is not good space will. It is not good space will. It is goodwill. It's one single word. Remember from that. It is nothing but the reputation, future profit earning capacity, or an intangible asset, name and fame, or the super profit earning capacity of the firm. Yeah, but I will define goodwill this way. Goodwill is the probability that the existing customers will stick to same business. If I'm running a business, some customer walked into my store yesterday. What is the probability that the same customer will walk into my store even today and then buy the goods today? The probability of he walking in again today and then doing business with me is my goodwill. Got it, guys? Fantastic. Chalo, let's start. Goodwill is accounting policy. There are multiple methods to compute goodwill. Average profit method, super profit method, capitalization method, and annuity method. Average profit method mein there are two sub methods called as simple average profit and weighted average profit. Let us see how is this working. Yeah, and in here goodwill is computed as adjusted average profit multiplied by number of years purchased, meaning whatever is the profit that can be maintained in the future, that is adjusted average profit. Average of the profits less non-recurring and exceptional items. And I told you it is the probability that existing customer will stick to my same business. If in case I say my old customer will stick to my same business for next 3 years, so profit that I'll make for next 3 years is my goodwill. It's my asset. Got it? So average profit that I'll make for the future multiplied by number of years for which the customer will come and do business with me. That is my goodwill under average profit method. That is the reason we do here into number of years purchase. I don't think many of us usually understand what exactly is number of years purchase. Formula says number of years purchase, we do number of years purchase. But we need to pay weightage to the definition of goodwill here, which says goodwill is probability that the existing customers will stick to same business. So this definition what I mentioned now will substantiate the reason why we multiply by number of years purchase. Guys liked it? मजा आया? तो ऐसे मार दो ना, ऐसे मार दो ना थोड़ा. Yeah, if you guys do like it, please do hit the desk once. Yeah, a small gesture of happiness. Okay, then how to find adjusted average profit? It is nothing but future maintainable profit. From the profit, we eliminate all the abnormal incomes and abnormal expenses like insurance claim, lottery profit, profit on sale of asset or loss on sale of asset and all such things. Got it? Then let's go to weighted average method. Weighted average method mein we add weights. Now usually under simple average method we take 1 lakh plus 1 lakh 20 plus 1 lakh 40 plus 1 lakh 60 divided by 4. Under weighted average method, we add weights 1, 2, 3, 4. Multiply with weights 14 lakh divided by 10. Weighted profit divided by total weights. That's how we arrive at weighted average profit. So this will give importance to the trend which the profit is following. If the profits are simultaneously increasing every year or decreasing every year, such trend will be adjusted under weighted average profit method. That's weighted average profit. Then let's go down to see super profit method. See, profit everyone makes. If you make more profit than everyone, that is your goodwill. So under super profit method, goodwill is found as super profit multiplied by number of years purchase, not normal profit. What is super profit? Super profit is profit that you made over and above normal profit. Like everyone makes 10,000 profit. I made 12,000 profit. So the 2,000 what I found extra is my super profit. So under super profit method, goodwill is super profit multiplied by number of years purchase, wherein super profit is determined as actual profit that I made minus normal profit. 12,000 that I made minus 10,000 what everybody makes. You get this? 12,000 I made is okay. How do you identify 10,000 that everybody makes? That is based on the normal rate of return. Assuming that I started business with 1 lakh rupees capital, every person on the planet can make 10% rate of return. So 1 lakh into 10%, normal rate, everyone makes 10,000, but I made 12,000. So 12,000 is what I made, 10,000 is what everyone makes. Difference 2,000 is super profit. Multiply by number of years for which I can do that super profit. That is goodwill. So goodwill is super profit multiplied by number of years purchase. Super profit is actual profit minus normal profit, and normal profit is found as actual capital employed multiplied by normal rate of return. Get this? Now let's go down to the next one, that is capitalization method, which is opposite of super profit method. Under this, what we do is profits are equal. My profit is 10, my competitor's profit is also 10. But my goodwill is what I've introduced lesser than what he has introduced as capital. I have introduced capital of 80,000 and made profit of 10. My friend has contributed 1 lakh rupees to make profit of 10,000. So to earn the same profit, I've introduced lesser capital. I've compensated it by introduction of goodwill. That 20,000 what I've not contributed, but I've earned the same profits as someone who's contributed is my goodwill. So goodwill under capitalization method is computed as normal capital what everyone will invest minus actual capital what I've invested. Everyone will invest 1 lakh rupees to earn 10,000. I've invested only 80,000 to earn 10,000 rupees. So what everyone invests minus what I've invested is my goodwill. Now the question is, actual capital will be found, assets minus liabilities. How do we find normal capital? To earn a profit of 10,000, normal rate of return is 10%. Meaning you should invest, you are only getting interest at, you are getting returns at 10%. Meaning to earn 10,000, one has to invest 1 lakh. I've invested only 80. So that difference is my goodwill. Normal capital is found as actual profit divided by normal rate of return. Got it, guys? So this is capitalization method. Then we have annuity method, wherein we take the adjusted average profits or super profit multiplied by annuity factor. Annuity factor will be given to us in the question. Let us not get into the zone of computation of annuity factor. However, in the regular batch, it's less on annuity factor, teach people how to compute annuity factor also. However, it's not required. You guys can relax. So this, my friends, is computation of goodwill. I hope you all understood computation of goodwill. Let me now take you to admission, retirement, and death of a partner. Shall I? And also towards the end of this video, I will revise the topic of JLP, which you people love the most. Isn't it, guys? Don't you love it? The topic of JLP? I know you do. Hello. Let's go to admission. In the case of partnership firm, to increase the scale of operations, to increase the capital, to increase the managerial people involved in the business, they'll go for admission of a partner. They'll admit a new partner. Whenever they admit a new partner, incoming partner is buying his share of profit. Incoming partner is buying his share in the assets. Incoming partner is buying his share in the liabilities in the business. That's what is the attitude, or that's what is the perspective that is very much needed. Remember, in the case of admission, the new coming partner will buy his share of profit, will buy his share in the total assets, will buy his share in the total liabilities from the old partners. So when I say buy his share of assets, he'll also buy his share in goodwill. He has to buy by paying money to the old partners. The reason is, old partners have worked hard to build that goodwill. Now the new partner is going to enjoy that goodwill in the future. Yeah, we usually think new partner brings in goodwill means he'll bring goodwill to the business value will go. Business already has value, he is getting himself into that value now, he is also participating in that value by contributing money to old partners and buying their goodwill, making it his goodwill. Understood? Fantastic. So what we need to do is he'll get part of profit. Assets and liabilities have to be revalued because he's buying business. No, if you have to buy business, it needs to be valued. So we'll prepare revaluation account, revaluing the profits and losses. When we do revaluation of profits, revaluation of assets and liabilities, there will be some revaluation profit or loss which needs to be given to old partners in old profit sharing ratio. Then we'll determine what is the capital, how the capital should be in the new after the entry of the new partner. So we need to adjust the goodwills that he brings in, adjust the capitals, and then redraft the balance sheet after the admission. Got it? So first thing is profit sharing ratio. Previously partners were sharing profits, that is old profit sharing ratio. Once the new partner comes in, what they share it in is called as new profit sharing ratio. When the new partner comes in, old partners have to make some space and accommodate the new partner. To that they give up some part of it, that is called as sacrifice ratio. Always remember, old profit sharing ratio will be greater than new profit sharing ratio in the case of admission, because old partners sacrifice to arrive at new profit sharing ratio. So remember the formula, OPSR is greater than NPSR. OPSR minus sacrifice ratio is new profit sharing ratio, and the sacrifice of old partners is the share of the new partner. Done. There are several cases on which you need to do problems on this. I have simplifiedly put here doing your favorite cartoon show of Chota Bhim Chutki Raju. You can read that and understand. I have given few important pointers also that you need to remember. Whenever there is an incoming partner, if nothing is mentioned, then old profit sharing ratio itself is sacrifice ratio. They contribute in the same ratio. And when incoming partner share is mentioned, they can give it in two terms. One, they can use the word from. Second one, they can use the word or. Whenever they use the word from, directly subtract that fraction from old partner's share. If they say of, then multiply and recipient or result from the multiplicand is deducted. You get this? So remember, from straight minus, of multiplication and then minus. So that is something that you need to remember. If you do example problems, you will understand this better. So then what we need to do? We need to revalue the assets. Whenever asset value goes up, asset value increase, it is profit. Whenever asset value decrease, it is loss. Same with ulta is with regard to liability. If liability value increases, it is loss. If liability value decreases, it is like profit. Got it? So if there is any unrecorded asset or unrecorded liability, treat it like asset was recorded at 0, now its value is increasing, or liability was recorded at 0 and now its value is increasing. That's the easier way to crack this logic. And any revaluation profit or loss will be transferred to partners capital account, old partners capital account in old profit sharing ratio. And remember, goodwill, though it is an adjust, it will be adjusted separately, and don't treat it along with revaluation of other assets and liabilities. Got it? And certain cases may this needs to be done every time when there is reconstitution, that is in the case of admission, retirement, death, every case may, or when there is change in profit sharing ratio, you should always prepare this revaluation account. Done. So revaluation account format is also given up here. Credit side represents incomes, that is increase in the value of the asset or decrease in liability. Debit side expenses represents losses, that is decrease in asset or increase in liability, and it will lead to profit, credit, debit side in revaluation account, credit side in partners capital account. If it is loss, then it is credit in revaluation account and debit in partners capital account, sharing them the losses. Fantastic. So then we'll go to memorandum revaluation account. Certain cases may the organization doesn't want to change the value of assets but needs to share revaluation profits or losses. So what do? We do it like the routine revaluation account. Account for increase in the asset, decrease in the assets, increase in liability, decrease in liability, identify profit, share it to partners in old profit sharing ratio. But if you do this, profit will go to partners, but assets and liabilities also will change. They don't want to do that. In that case, we'll do everything ulta. Whatever was debited here, decrease in asset, will now be credited here. Whatever was credited here, increase in the value of the asset, will be debited. So everything will do ulta. Debit sides will become credit side will become debit side. And this profit, ultimately what was shared to old partners only, will now be written off by crediting all the partners. including the new partner, in new profit sharing ratio. What happens by this is the incoming partner will give the realization profit that needs to be given to old partners without changing the value of assets. So the objective of memorandum revaluation account is not to change the value of assets and liabilities, continue to record them at book value. However, the revaluation profit which was entitled to old partners is compensated by the incoming partner. You get this? So that is the objective of this memorandum revaluation account. Yeah. Then goodwill. This is a very important part. Lot of them have a very bad understanding of goodwill. Everyone thinks that goodwill will increase in admission. Nah. Goodwill of the firm remains same, and it is because of the efforts of the old partners. The incoming partner is buying his share of goodwill from the old partners. Old partners are sacrificing it. So the consideration what the new partner brings in towards goodwill should go to old partners, because it is their goodwill what is going to become the new partner's goodwill anymore. Their share of goodwill is sold by them to the new partner. Got it? So whenever if he brings his share of goodwill in cash, then we'll write the journal entry cash account debit to goodwill, and this goodwill is shared between old partners in sacrifice ratio. If he doesn't bring his share of goodwill in cash, if he brings it in kind, then we'll write asset account debit to goodwill, and then such goodwill will be shared to old partners in sacrifice ratio. If he doesn't bring his share of goodwill, goodwill is to be raised and written off. We write the entry goodwill account debit to old partners capital account in old profit sharing ratio. We write it off by writing all partners capital account to goodwill account in new profit sharing ratio. This will adjust or give credit to old partners for their share of goodwill, and it will decrease the new partners capital account. Done? So this is the kind of adjustment. In one of the mock test paper questions, a very interesting part, there was a goodwill adjustment. They've asked you to raise goodwill only. They've not asked you to write off goodwill. This majority of the students will go wrong. So please do see mock test paper 2 if I'm not wrong, wherein there is a question on partnership. When I did it in the class, I marked it red, saying it is an important question and must do before exam. So please do see that, guys, and it will help you prepare well in the examination preparation. Done? So then it can be adjusted through capital accounts. Will not write goodwill account at all. The new partner should compensate. No, you will reduce his capital account. So debit is capital account, and it should be given to the sacrificing partners, right? So their capital accounts will be credited. Entry will be new partners capital account debit to sacrificing partners capital account. This is to be done in the sacrifice ratio. That's it. So after all of this, all you would have to do is there can be question on hidden goodwill, so which will be computed based on the new partner's capital, new partner share. You reverse the new partner share. If he is coming for 1/3 share for 1 lakh rupees as capital, do 3 and then multiply it with 1 lakh. Identify the total capital of the firm. Deduct it from check it with the total capital including new partner and old partner. The difference will be hidden goodwill. So the questions can hidden goodwill also can come. See here, capitals of A and B are 30,000 each. C comes for 1/3 share, bringing 50,000 capital. If he brings 50,000 for 1/3 share, total firm capital should be 1,50,000. But total capital is 50,000 he brings, 30,000 A and B. So 30 plus 30 plus 50, that is 1,10,000. But it should be 1,50,000. 40,000 is the hidden goodwill. Yeah. So this kind of adjustments can also come in the question, which you guys need to be little prepared for. And by this I've completed every single aspect of the topic of admission. You need to know revaluation, partners capital with capital adjustment and goodwill adjustment and balance sheet. And of all the adjustments that we've done in revaluation, you need to restate the values in the balance sheet that is prepared after. JLP, I'll teach you guys at the end after we do the topic of retirement and death. Got it? I'll take another 10 minutes. I think it's not an hour yet. Is it an hour? It is just an hour. We'll take another 10 minutes and then quickly finish off the topic of retirement and death. We will, however, do the topic of our next 2 chapters, that is company accounts and NPO, in the next video. Yeah, it will be a 6-part revision in that case. Got it, guys? Very good. Retirement of a partner. A partner can retire either because of his old age, or he fought with other partners, or he doesn't want to continue any longer, decrease the scale of operations, or continuous losses, or anything. Yeah. So the perspective is the retiring partner is selling his share in the assets, selling his share in liabilities, selling his share in profit to the continuing partners. That's what we need to remember. Exactly like admission process whatever we did, no, we need to recompute the profit sharing ratios, revalue assets and liabilities, arrive at revaluation profit or loss, share it to old partners, adjust goodwill, adjust capital, adjust balance sheet, adjusted balance sheet after retirement needs to be prepared. Everything else will remain same here except for the case of goodwill adjustment. So I'll quickly run you through. You just need to know the ratios also. There are three ratios here: old profit sharing ratio, new profit sharing ratio, and gain ratio. Gain ratio is opposite of sacrifice ratio. Yeah. So in the case of retirement, what happens is old profit sharing ratio plus the gain ratio will be new profit sharing ratio. So the new ratio will be greater than the old ratio because the continuing partners are gaining, no? The retiring partner share is now their share. Got it? Fantastic. So there are few adjustments on ratios. I have given important points also. When they don't tell anything, OPSR is NPSR, NPSR is gain ratio. However, if they do mention how to compute, if it is equal, not equal, how to compute, I have given an important point to remember. You guys can read this. That should be able to help you all. Yeah. And revaluation of assets and all is same like how we did. Yeah. Here. Goodwill adjustment, same as previously discussed in admission. Incoming partners buys goodwill from old partners in the case of admission. In the case of retirement, the retiring partner will sell his goodwill or give his goodwill to continuing partners. Continuing partners will take over that goodwill from the retiring partner. Got it? If raised and written off, then first entry is goodwill account debit to old partners. For writing off the entry is new partners or continuing partners to goodwill. So rest of it is same like how we do in the case of admission. Not much of a difference. You guys can practice few problems on retirement and that will definitely take you guys through. And then I'll quickly take you guys through the death of a partner as a topic. Yeah. So whenever a partner dies, it is little similar to retirement, but not exactly retirement because retirement is planned. You will plan the retirement of a partner at the end of the year. Death can't happen like that. So partner will be, he will be there in the partnership form till one date and after that he'll stop being partner. So what you need to do is the period for which he was as a partner in the firm till that date, till the date of death, we need to give him his share of capital as on the date of death, interest on capital till the date of death, share of profit till the date of death, any remuneration that is eligible to get till the date of death, his share of goodwill as computed on the date of death, share in the reserves, accumulated profits, share in revaluation profit or loss as on that date, interest on drawings, everything needs to be computed and then given to him. In this, no, everything is similar, like share of goodwill can be computed, capital, interest on capital, remuneration, revaluation profit is easy. But interesting part is share of profit. How do we compute share of profit? Usually profit is computed at the end of the year. Here the partner dies in the middle of the year. How do we compute profit if the partner dies at the middle of the year? It is computed on an estimated basis. Yeah, we'll take the previous year or few previous years profit and then compute, arrive at an estimate as to how much profit would have been earned in the period for which the partner was alive. Assuming in the previous year or previous years 1,20,000 was the profit, annual profit. This year my partner was alive for 9 months. So we say 1,20,000 for 12 months. So for 9 months what the partner was alive, profit would be 90,000. So that way we compute expected profit and on that expected profit we compute his share and then give it to him. And it will be written to Pnl adjustment or Pnl suspense, which will be adjusted at the end of the year. So till then it will remain that way. So that's an important point that you need to know. Yeah, and one important section that we need to remember before we go ahead is section 37. In the case of death of a partner, we might not be able to immediately settle the deceased partner's share, entire amount that belongs to him. So what do? We'll transfer it to executor's account and we need to pay from that. If in case we don't pay that money, this happens even in the case of retirement also, if it is not paid within the time, so for the period the amount is not settled, the deceased partner's legal heirs or the retiring partner will be eligible for share of profit proportion to the amount outstanding or interest at 6% on that amount outstanding, whichever is beneficial to them. I'll repeat, to the extent amount is not repaid to the deceased partner or the deceased partner, you will get proportionate share in the profit for such period on that amount outstanding or interest at 6%, whichever is beneficial to such partner or partner's dependents. So that, my friends, is section 37, what you need to know. Let's quickly discuss JLP and then say tata bye to this session, and we'll discuss NPO and company accounts in the next session. So joint life policy Firstly, remember it is a policy taken on the lives of all the partners by the firm, not by partner individual. It is a policy taken on the life of the partner by the firm. Firm will pay premium. Firm has secured the life of the partner, because if in case any of the partner dies and the capital needs to be repaid, firm is under loss. Firm doesn't have enough money to repay the capital. It might force the firm to go for liquidation. The firm will take the policy. Whenever firm takes the policy, firm would have paid the premium. Premium would be treated as expense in Pnl account debit side. So if the firm receives the policy money, such policy money should not go to that partner because he died. No, no, no. Entire money belongs to firm. Such proceeds should be shared between all the partners in profit sharing ratio. Now the question is, how much money will be received by the firm? The money that will be received by the firm from the insurance company is this way. If in case the partner is retiring, the firm will receive surrender value. If the firm, if in case of the firm, the partner dies, then the firm will receive the policy amount. Remember, in the case of retirement of a partner, we receive surrender value. In the case of death of a partner, we receive policy amount. Whatever surrender value or policy amount will be received will be shared between all the partners in profit sharing ratio. However, that is the profit part. The debit part, cash received, will be used to repay the deceased partner's share or retiring partner's share. Accounting of this JLP can be done two ways. It can be either treated as expense or asset. If JLP premium is treated as expense, then it would have gone to Pnl account. Entire insurance claim what we receive is shared between partners. However, if JLP is treated as asset, surrender value of JLP will be appearing in balance sheet. So when we receive the amount from the insurance company, it is like sale of an asset. Surrender value 10,000 is there. Policy 1 lakh. You receive 1 lakh. So 1 lakh is the sale consideration received for giving up an asset of 10,000. So we charge 90,000 or we distribute only 90,000 to partners. You get this? However, if there is no surrender value, then no surrender value or no value in balance sheet. Entire amount what you receive, you share. Do you get this? So remember this. JLP can be treated in two ways. JLP can be treated as expense or as asset. If it is treated as expense, entire premium paid would go to P&L. So entire policy amount or surrender value what we receive will also go to P&L and be shared between all the partners in profit sharing ratio. However, if JLP is treated as asset, then surrender value of JLP will be appearing in balance sheet. When we receive JLP money, to the extent it is surrender value, it is to be deducted from the JLP money. Only excess received is like profit on insurance claim, and that excess money only will be shared to all the partners in profit sharing ratio. So if you can remember this, and also remember the fact that in the case of death of a partner, we receive policy amount. In the case of retirement of a partner or surrender, we receive surrender value. We are done with JLP concept. This concept is minimum. This is more than sufficient for you to handle any problem on partnership accounts with JLP. However, if we discuss in detail, I can go on teaching JLP all by itself for next 2 hours. But marathon revision, if you know these 2 pointers, more than sufficient. And if in case there is any JLP reserve, treat it like any other reserve, distribute it to old partners in profit sharing ratio. Got it? That's it, guys. I hope you all understood the topic of partnership in detail in this quick revision or in this marathon revision. This is the end of part 5 of our CA Foundation Principles and Practice of Accounting marathon revision. I initially planned it to be 5. Now, considering the fact that we are not able to finish, I'll extend it to a 6th session. So we'll have another session coming up very soon, 6th session, wherein we'll discuss the topic of NPO and company accounts. So till then, remember, life is not a battle to be struggling. It's a game to be enjoyed. Till the time you guys are learning something new or having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question to all of you. Are we in the game? I hope yes, we are all in the game. That's it, guys. See you all in the 6th part, wherein we'll discuss NPO and company accounts. Till then, tata, bye bye, take care, stay in the game and get lost.